What's up guys, George here, and today I'm going to talk about the one critical rule placed by institutions that keeps new traders poor for their benefit and how to get around it. So if you ever traded stocks before, you've probably bought something immediately and instantly regretted it. Unless that's just me. But that's not a big problem, right? You can just sell it right away and cut your losses really quick. But as soon as you go to buy and sell something the same day, you get hit with this little notification. Now you might just shoo this away, but the problem lies in doing this 3 more times consistently because you just performed a day trade. Now all day trading is buying a stock or option and selling it within the same day that you bought it. Don't get this mixed up with swing trading, which is buying something and selling it on a different day than you originally bought it. But what happens if you execute more than 3 day trades in 1 week? Well, you get hit with the PDT limit. Your account basically just gets put into trading jail for 1 to 4 months, depending on the brokerage. And all of this is because you went over the PDT rule, or the pattern day trader rule, which is basically not having $25,000 worth of assets in your account during the time you perform those day trades. Before I tell you the steps on how to get around the rule, stick around to the end of the video where you can help me out with an idea on how to get rid of the PDT rule for good. First up on our list, we have the other trading method, which doesn't get you locked up in trading jail. The swing trade. Now this trading method is super simple. All you have to do is buy a share or option and sell it a different day than you bought it. It's a super simple method. So let's say you want to buy a share of SPY. Well, I bought it on Monday and all I got to do is sell it on Tuesday or later. And then I will incur no limit, no day trade limit, nothing. I can do this indefinitely. Now, swing trading can be a little riskier in my experience, mainly due to the fact that once the market closes, you have no idea what's going to pop up on the news. Did the stock market crash? Well, you don't know, so you're stuck in limbo until the next day. Another thing is, I don't like swing trading on weekends because then you're stuck in limbo for 3 days, and 3 days is way too much stress for me. But if you have high conviction and have done your research, swing trades can be extremely profitable, all while not limiting you like day trades due to the PDT rule. Now, the next method can be a little tedious, but it works very well. So remember, originally I said you could only have 3 day trades on account unless you had more than $25,000 in assets in your account? Well, that only applies per one account. Let's say I go over to Robinhood, I make my 3 day trades, then I hop over to Webull and make 3 more day trades. You won't get flagged for PDT because they're on separate accounts. And you can repeat this with any brokerage you find. It's a really neat trick. It can be a little tedious at first, setting up a new account, depositing money, but once you're done, you have 3 extra trades per account you create. Listen, sometimes you gotta be a little creative to get around these rules the institutions put in place. Kind of like our next trick on our list, offshore trading. Now, before you think of this as being some type of James Bond money laundering scheme, hear me out. What makes a brokerage become an offshore trading account is basically being outside of the US, not being forced to follow the US's mandates for financial legislation, which in layman's terms means no PDT rule. So if you open up an offshore trading account, well, you just go right to trading without worrying about any $25,000 asset value in your account and no PDT limit. You trade to your heart's content. The only problem I found with offshore trading accounts is they generally have a trading fee. Now, you might not be used to trading fees if all you've traded in your life is on Robinhood. But originally, trading brokerages, all of them here, had some type of trading fee from $6 to $40 per trade. Now, without that luxury of 0 trading commission, you really have to make sure the trades you do are on point and account for that cost you're about to do as soon as you sell. But as long as your trades outperform the commission, you can trade indefinitely without worrying about the PDT rule. Just remember, when you're signing up to an offshore brokerage account, make sure they're credible. If they're asking you for a Western Union or Walmart gift card, it's most likely a red flag. Now, the final and most trustworthy method to get around the PDT rule, which makes investors the most amount of money proven, is, well, hold on, it's a little boring, buying and holding. I know. Ugh. Buying and holding over the years has shown to turn a profit more times than not. And you don't have to deal with that stress on when to buy, when to sell, should I sell the same day, what's the market doing the next day? You just put your money in and relax for a couple of years. Now, long-term investors succeed most of the time. The same can't be said for day traders, because when it might look easy up front, the market can be volatile, and when the bulls and the bears start fighting, it can get super bloody, and you don't want to be stuck on the wrong side. So to avoid all of that, you can just invest your money into a good index fund and sit back and collect roughly 10 to 20% return a year without any of the stress of daily managing your money. But I know that's not why you guys came here. In the end, day trading can be a bit complicated, especially when needing to avoid the PDT rule. But there are many ways out there to go around it without having $25,000 in assets. Let me know if you guys want to see a video like that. And as always, if you enjoyed this video, hit that like button, subscribe, and I will see you guys next time.